I'm Rob Van Rapphorst. Welcome to MBA Now. We are here at MBA's 2017 annual convention. With me is the Chief Risk Officer for Radian Group, Derek Brummer. Thanks for being here.
Thank you for having me.
So first, let me ask you, what are the top 3 or 4 risks you see in the mortgage business over the next few years?
Sure, one of the first risks I see is increasing interest rates. So the market has priced in a certain number of interest rate increases, which is below what the Fed is forecasting. And so one is the potential impact from a macro perspective. So when you have rates going up, been a lot of liquidity provided by central banks for a number of years. When you see rates going up, one of the questions is what impact does that have? It could have an impact in terms of stock market correction, bond prices, and that can have contagion effect in the housing market. The other thing is more directly in the mortgage market is how the mortgage market responds to increasing interest rates. It's been a number of years, people in the industry haven't seen increasing interest rates. The question becomes, are institutions properly hedged from a risk perspective? Is our modeling picking that up from kind of a risk return perspective when you see interest rates increasing? So seeing how the market responds. Also what you're going to see with increasing interest rates is a movement towards adjustable rate mortgages. Probably see a bigger increase there, and probably a bit of an impact in terms of home price appreciation. We saw the taper tantrum in 2013. We saw an impact on home price appreciation and also home sales. So that'd be kind of first on my list. Second on my list would just be the decrease in refi volumes, which is also part and parcel of the increasing interest rates. When you have that environment, you have pressure on lenders from a volume, a profitability, and a margin perspective. And so how do they respond? And a natural inclination in an environment like that is to push the credit box. So from a risk side, what we're really focused on is what are lenders doing to make up for that volume? Are they taking outsized risk from a return perspective? So that's a big area of focus, and as part of that is just credit stretching. Obviously, everyone's looking to grow, and when you have rates potentially going up and volumes going down, is you see credit stretching. So trying to put people, perhaps borrowers, in homes they shouldn't be in, so that's a big impact. And another thing we're continuing to focus on are home prices. So generally, if you look at overall, home prices are pretty in line with fundamentals, but what we've seen after home prices kind of bottomed out, we've seen home prices increase about 6% per year, while wage growth has been about 2.5%. And there's only so long where you can have that disconnect. So you really want to see those move back in line. One of the potential positive effects by having rates go up a bit is to take some of that home price appreciation, kind of the winds out of the sail with respect to that. Now, I would distinguish between what we saw going into the financial crisis insofar as home price appreciation has largely been a lack of supply. So what you would expect is you have a pretty good supply, you have millennials coming into the market, so if you see home prices, you don't really see it falling out. You kind of have a natural floor for home prices, but you'd probably want to see that more connected to wage growth.
You mentioned it a little bit, but what's your perspective on the current state of mortgage credit, and how do you see that playing out over the next few years?
Sure, so overall, again, I think when you look at mortgage credit, you have to distinguish really today versus what we saw really kind of leading in the financial crisis. So very good foundation when you look at credit quality. Credit scores continue to be very high. If you look at loan manufacturing quality, so much higher today. So a very good foundation. Also, there are regulatory guardrails around really mortgage credit. So you have the qualified mortgage rule in place. You also have servicing standards we didn't have pre-crisis. You have consumer protection laws in place, so that cuts down on the potential for fraud, and also many of the exotic products we saw really going in the financial crisis. It's hard to see those returning, and part of the reason being is the amount of capital that has to be held against those products, and for instance, as a mortgage insurer, what would have to price makes many of those products untenable. So I think you have a very good foundation. Now, that being said, from a risk management perspective, you don't want to become complacent. So one of the things we focus on very much is what we look at as risk layering. So to the extent that we've seen an expansion in credit, really post-crisis, it's been a very kind of gradual expansion of credit, and that's what we want to see. So what we're looking out for are any sudden shifts in credit, and also where we see risk layering. So what I mean by that is where you see multiple risky attributes layered on top of each other. So let's say, for instance, a greater than 45 DTI with a low FICO and maybe a high LTV. When we start seeing a lot of that, that was a big problem in the financial crisis. To date, we haven't seen a lot of that, but that's something we watch very closely. So when we see that, that's when we become concerned. And the other thing we focus on at Radian a lot is Distinguishing customers. So which customers is it appropriate to expand the credit box? Are they doing it prudently? Do they have the right risk culture? And also, is the data in terms of performance really supportive of what they're doing from a credit perspective? So that's a big area of focus.
When it comes to managing mortgage risk, can you talk about the importance of governance and culture?
Hugely important. So one of the things, everyone's focused on data and analytics, which is kind of a core principle, kind of really what you need as a foundation. But ultimately, I firmly believe if you look at institutions in the financial crisis, those that performed versus those who didn't really came down to one, a risk culture. And oftentimes what you see is those institutions that had problems in the financial crisis were ostensibly sophisticated institution, had great data, great technology, but pushed the envelope. And the biggest thing from a risk culture perspective is that focus on long-term, through the cycle, sustainable profitability. And that's usually where institutions stub their feet. And oftentimes what you find is institutions who oftentimes rely excessively on modeling, they lose kind of sight of the qualitative factors and the risk culture. So when the credit cycle turns and you need to move back, you need to have a strong risk culture, governance from a risk appetite, risk tolerance perspective, because it becomes very hard, especially when volumes pick up, to be the party to say we need to step back. So it's important to have that risk culture and build it up in good times, because you're going to need it in bad times, and you need to be ready to respond. So at Radian, from a risk management perspective, our first priority every year is risk culture. That's our top priority every year, and will continue to be so, because ultimately if you don't have that, you can have the best data and analytics in the world, but you're going to have problems once a credit cycle turns.
It's fascinating insight on so many levels. Thanks so much for stopping by, Derek. Really appreciate it.
Excellent. Thanks for having me.
Be sure to follow us on Twitter at MBA Mortgage and like Mortgage Bankers Association on Facebook and Instagram.